of the basics, and Adam, I'll ask you to take it away.
Thanks, Dwayne. So we can kind of just start by talking about what is estate planning. A lot of people think if I have a will in place, everything's taken care of, that's fine. When we refer to estate planning, we're talking about a lot of more in-depth details, things like what might the tax implications be upon passing? What's your family structure? How do you want to pass on these assets? How are your assets held currently? So there's a lot more than just a will. We do kind of think of that as the centerpiece, but from a broader perspective, there's a lot more details that go into an actual estate plan. So when we talk about estate planning, the three kind of main goals that we look to achieve are, the first one there, minimize tax and costs. So we'll dive a little deeper on that. When we talk about taxes and costs, we're referring to income tax and probate fees. So we'll discuss the differentiation, but our main goal is we can't eliminate tax, but there's definitely some strategies we can implement to minimize it. Minimizing delays on the estate. So this is a really important one. Just by having open lines of communication, by making sure there's a plan in place when someone does pass away, it can prevent future issues if there's a clear plan. One good example for this would be if you have young children beneath the age of 18, if you were to pass away and those assets were left, they might not have access right away. So things like having a trustee in place can avoid any delays so that they can be provided regular funding. So that's just one of the examples of ways we can prevent issues and delays when someone does actually pass away. Clarity for beneficiaries. This is a big one. If there's discussions in advance, if people know that they're beneficiaries, executors, powers of attorney, you're not really starting from scratch. Everyone has a clear understanding of what's happening moving forward. There's not any confusion with strategies, and it can lead to kind of that expedited dealing with the estate and to avoid some of those delays. So when we talk about an actual estate distribution, one thing that's important to point out is, you might have heard of the phrase, fair doesn't always mean equal. That really speaks to estate planning. Oftentimes people try and be overly specific with what they want to do, which can lead to larger issues down the road. So an example of this would be, it's very difficult to know what the exact dollar amount of your estate would be when you pass, because you don't know when that time's going to be. So it's hard to be too specific. The big issue arises if you're trying to be overly tactical without looking at the whole picture. It can lead to things like additional income tax, additional probate fees, and those are all things that we want to look to try and avoid. So what we can do now is just go over a couple examples. These are really good to highlight and kind of illuminate some of the issues that can arise. So a common one is, say there's a family cottage and parents plan to leave this to their 3 children. So as of today, it's worth $600,000, and their viewpoint is, well, do you know what? Let's make this very fair and equal to everyone, and we're going to give a third to each child, $200,000 or a third of the cottage value to each. An issue arises because maybe one child sees this as the cottage they spent their summers at and they're attached and they want to keep it. Maybe the second child says, well, do you know what? This is a really good opportunity for us to rent it out, generate some good cash flow. And then maybe the third child has a spouse that has a cottage and they're not really interested. Their viewpoint is, well, do you know what? I just want to take my third share and call it a day. Well, what happened was, from a parent perspective, they split things up equally, but without having that discussion of what each child actually wants, it's going to lead to some, like we said, delays on the estate, because there will inevitably have to be discussions, potentially disputes over what should happen with this cottage, as all 3 of them basically retain some ownership. So that's why it's really important to have those discussions in advance. First, it's great to know what you want to do with your assets in estate, but it's really important to get feedback from those beneficiaries. Because if you know in advance that only one of your children want that cottage, there's lots of things that can be done. You can have it set up that within your will it states that that one child gets the cottage and their portion will be excluded. The fair market value of the cottage will be excluded from their share of whatever else is left in the estate. You can have things set up so that there will be funds maybe from an insurance policy that deals with this, so one child doesn't have to come up with the money to buy out another. So all to say, having the discussion in advance can lead to fewer problems or issues. Another common one is with blended families. So when we talk about blended families, it just simply means if you have children from a previous relationship. So because there's a level of complexity to that, it can also lead to some issues. So this is a really good example. Say there's a husband and a wife. Each of them have children from a previous relationship. So as many of you may know, there's rules that allow for spousal rollover. What that basically means is, say the husband had an RSP and the wife was the beneficiary. There's rules in place that allow that to roll over to the wife tax-free. So it makes a lot of sense for a husband to name a wife as a beneficiary, vice versa. It's going to avoid some tax implications. So makes sense from a tax perspective. The issue is from an estate perspective. Say the husband in this scenario passed away. His assets rolled over to his wife as planned because they didn't want tax implications. But her will could say everything gets left to her children. Well, in a roundabout way, this husband unintentionally disinherited his children just because of the mechanics of how it all works. So once again, there's a lot of ways to deal with this and mitigate it. Oftentimes in these scenarios, there might be provisions in the will that say the wife can stay in that same home, but the assets will go to the children. You can have a trust in place that the children are the capital beneficiaries, so they will receive the bulk of the assets. But while the wife is still alive, she's an income beneficiary, so she can receive some of the regular income that's generated. So there's lots of ways to deal with this. It's just important to note, the more complex the situation, the more issues that can arise and the more planning that needs to take place. So as I mentioned, the will is the centerpiece. What it does is it names who your executors and who guardians are. So in simple terms, an executor is the person that's going to basically honor your wishes. When you pass, they're going to follow the wishes within your will and basically administer your assets as per that will. So it's really important that they know that they're the executor. One, because it is a lot of responsibility, and it's important that they're comfortable with that role. And then the other thing would be it names guardianship. So if you have younger children, it's important to not only make sure that they can be taken care of upon your passing, but oftentimes simple things like making sure there's a trustee to distribute those assets to children makes a lot of sense. Whether they're beneath the age of 18 and may not have access yet, or if they're 18, it's not always ideal to just have those assets available. So you can set up various trust structures that could say every 5 years they get 10% of what your estate is. So there's lots of ways that this can be phrased within a will and set up. All this to say, the more complex the scenarios, like I said, with blended families, special needs beneficiaries, anything of that nature, it just adds a level of complexity and really hits home that a will is important. So a lot of people are intimidated to get their wills done or redone or updated. And I think the common thought is that you have to know the legal terminology or jargon so that everything's set up properly. That's not the case. It's fairly straightforward. You can just go to a lawyer speak in simple terms. I want this asset to go to these children. I want to make sure this happens when I pass away. If you can speak in plain terminology, they'll paper it for you. So don't feel, as intimidating as it can be, don't feel like you need to go into the process being an expert. Okay, so now we'll just talk about tax. Once again, I'll emphasize the fact that minimized tax, we won't be able to eliminate it, but we can definitely look to try and minimize it. So when we talk about tax, there's two types. There's income tax, and then there's probate fees or estate tax. Kind of interchangeable terminology. When we talk about income tax, that's probably what most of you are familiar with. As you earn regular income while you're working, taxable income in retirement, all of that is exposed to income tax as per normal. The different one upon your passing is probate fees or estate tax. And basically what this is it's a fee that the courts levy to honor your will and allow it to be administered. So in Ontario, it's about 1.5% of your estate. So when we look at these two different types of tax, we really like to think of probate fees or estate tax as the little tax, 1.5%, and then income tax as the big tax. As a lot of you know, in Ontario, highest marginal tax rate is above 50%. So a lot of people really try and avoid probate, which can make sense, but it's important to distinguish the fact that in the grand scheme of things, income tax can be a lot more punitive than those probate fees or estate tax. So we'll just start by talking about income tax, then switch over to probate. Income tax, so what tax might you have to pay, your estate have to pay, sorry, upon your passing? So regular income, pension income, interest, dividend income, that's kind of that regular income. That's the same as normal. The two differences would be with non-registered assets and registered assets. So it's probably worthwhile to distinguish the two. When we talk about registered assets, those would be RSPs, RIFs, TFSAs, anything with a named beneficiary. When we talk about non-registered assets, as implied, they're not registered. So it could be something like an investment account. It could be a property, so a cottage that we referenced. Anything that's not registered would fall into that category. So the big difference is upon your passing with those non-registered assets, the assumption is that there's a deemed disposition. So what that means in simple terms is it assumes that you sold those assets at the date of your passing. So in Canada, we have 50% inclusion rate. What that basically means is for non-registered assets, 50% of the gain is taxable, and it's all taxable in that year of passing. And we'll walk through a quantitative example in a second. When it comes to registered assets, 100% of RSPs and RIFs, all of those are taxable in the year of your passing. Now, what I will say is we talked about spousal rollovers. So there's a husband and wife in that same scenario, the husband passes away. RSPs can transfer over to the wife without tax implications. So really, in a lot of scenarios, it's upon the second passing that this tax implication occurs. Okay, so this is a really good example to illustrate it. So regular income, say this person passed away September 30th, so they were alive for 3/4 of the year, and they regularly receive 80,000 of pension income. So 3/4 of the year, 3/4 of that is 60,000. That's pretty straightforward. Their regular income, 60,000 for the year. Now, on non-registered assets, so let's assume that they have an investment account that's worth $500,000. Let's say years ago they put in 300,000, so over time it grew to 500,000, assuming that there's a gain of $200,000. So based on what I mentioned before, 50% of the gain is taxable, which means $100,000 would be taxable. And then finally, the RSPs and RIFs, say there were residual RSPs left over, $300,000 worth. Those are all taxable in that year of passing. So what this illustrates is, in this scenario, there'd be $460,000 of taxable income. A lot of people don't realize that oftentimes the year that you pass away can be one of the largest tax bills that you actually have. Now it is your estate paying it, but if we're just using simple numbers, 50% tax rate, well, 230,000 went to the CRA in the form of income tax. So this is a really good example to show that. We'll talk about some strategies that can help deal with that, because as I mentioned before, there are things that can be done to minimize some of those tax implications. So what are those? Spousal rollover, I've referenced that a couple times, allowing funds to transfer to a spouse. Principal residence exemption. So this is currently still available. This would be something that your accountant would work with you to determine, but in simple terms, what you're allowed to do is have your primary residence not exposed to that, to their capital gains being taxable. So say you're retired and you had your kind of traditional home and a cottage, and you split time between both of them. Your cottage has appreciated at a significantly higher rate, so there's a larger gain. What you can actually have done is you can claim that cottage to be your principal residence, and it makes sense because you're sheltering the asset that grew a lot more, that would have more of a gain and more tax implications. So once again, something that would be done by your accountant, but there's some flexibility there that can help to reduce some of the tax implications. Charitable giving, if that is something you plan to do, there's lots of ways that can be done to reduce your tax burden, and we'll actually talk a little more in depth about that in a bit. Inter vivos gifting. So this is a big one. In simple terms, it just means gifting while you're alive. That's Latin for while living. The caveat to this would be ensuring you have a financial plan in place, ensuring there's an estate plan. Once we can see that there's residual or unused assets upon your passing, it makes a lot of sense to gift in advance for two reasons. One, we can avoid some of that deferral because we saw some of those tax implications if you leave things to the end. So we can work to level out the taxation. The other big benefit would be you can gift that money while you're still living. So oftentimes a lot of people feel that it's nicer that they can provide those gifts to children or grandchildren and see them enjoy it, whether it's them being able to put a pool in, or maybe it's going on a family trip. It's something that you can see them enjoy instead of just waiting until you're passing and leaving them whatever left over. The last one there is RSP and RIF drawdown. The traditional wisdom used to be wait till age 71 and then just start to draw on these assets, because a lot of people thought, well, why would you ever want to pay tax when you don't have to? That thinking has kind of changed over time, and our approach towards it is also different. Generally, what we look at is if we can keep you in that same marginal tax bracket, what we try and do is move some money from your RSP or RIF to your TFSA. So you're paying tax at the same tax rate, but what it's going to do is level out the taxation once again, because you're doing it gradually over time. The big benefit is we would transfer the funds to a TFSA as an example. So not only are those funds now tax-free, but all the future growth on those funds are tax-free as well. So if we can do that and start that process early on in retirement, there's going to be a lot of growth, and eventually we're going to divert a good portion of the taxable assets to tax-free assets. Charitable donations, so there's a lot of things that can be done. You obviously receive tax credits if you make a charitable donation. There's other strategies that can be implemented, whether it's a non-registered investment account. You can transfer to a charity and not have tax implications. You can have a charity named as a beneficiary of insurance policy. You can use it to offset 100% of your income in the year of your death. So not to suggest this should be done, but if your intentions are to leave something to a charity, there's a lot of ways that that can be done that are favorable from a tax perspective. Okay, so that was income tax. Now circling back to probate fees or estate tax. So as mentioned, this is basically just a fee that's levied by the courts to basically honor and administer your will. It's 1.5% in Ontario. And the really important distinction is probate fees apply to anything that passes through the will. So a lot of people think, well, I have a will, everything's going to follow that. That's not always the case. Say you have one child and you have a TFSA worth $50,000. If you name them as a beneficiary, upon your passing, a $50,000 check will go to that beneficiary. So it does not flow through your will. There's no probate. So that can make sense. It can also create some issues because maybe your will says, I want everything to be split evenly between these three parties. Well, those assets didn't flow through the will, so they're not going to go to all those parties. It's already been dealt with. So really important to distinguish that probate fees only apply to assets that flow through the will. And assets that would flow through the will would be any registered accounts where estate is listed as beneficiary, or any of those non-registered assets because you can't have a beneficiary designation. So this is a good example that kind of speaks to that. What this assumes is there's a widower who had two children and they want to treat them both equally. So there's $200,000 in RSPs, $200,000 in a non-registered investment account. Well, they might say, okay, I'm going to name one child as the beneficiary of the RSPs, and I'm going to save some tax because there's not going to be probate on it. The other child will get the non-registered investments. They're each getting $200,000, no issues there. Well, what happens in reality is with the RSPs, that $200,000 goes directly to that beneficiary. Receive a check for $200,000. The non-registered assets, those will flow through the will. So in this scenario, we talked about those tax implications before, the income tax. Well, what actually will happen is the estate has to pay the income tax. So they'll pay the income tax using those non-registered assets, and then there's only $125,000 left over for the other child. So what happened here is unintentionally created an unequal distribution just by trying to be a little too specific. So what are ways to deal with this? Both children could be beneficiaries of the RSPs, and then non-registered assets go through the will and are distributed. That would create an equal distribution. Another option is have a state listed as the beneficiary of your RSP. So a lot of people would say, well, why would I do that? Then there's going to be probate. Yeah, that's true. In complex scenarios, maybe those blended families we talked about, maybe there's intentions to pass things along to children and grandchildren. So there's 6 parties involved. As soon as there's complexity, it's often easier to say, okay, RSPs, those can go to the estate, the tax can be paid, whatever's left can be distributed, because with those beneficiary designations, assets will flow out in advance. Someone has to pay the income tax bill, and if there's not enough assets in the estate, well, then you might need to gather those assets from some of those beneficiaries. So it just leads to potential future issues and disputes, and oftentimes, if things are complex, it's worth having probate fees just to create the simplicity upon your passing. Joint ownership. So this is a question we often get. So say there's a parent and a child and they have an investment account. A lot of people look to add that child on And the benefit there would be it seamlessly rolls over to the child's ownership and doesn't flow through the will and is exposed to probate. So in some scenarios, yeah, this could make sense. What this leads to is the risk of kind of that unequal distribution if your will says differently. But the bigger issue are the tax implications. So on this investment account, there might be regular interest and dividends being generated. Well, if the parents retired, maybe their income's lower, so this isn't as big of a deal. But if the child's still in their high income earning years, you may end up paying more tax than you would have before, just based on the fact that you're adding additional income to someone in their high income earning years. Same thing applies with capital gains. Say you're on this account, joint owner, parent and child. The parent needs some funds. So say they pull out some money and there's capital gains. Well, that child is joint owner, 50%. So they're going to have to pay tax on some of those capital gains, and it might be at that highest marginal rate. So all this to say that it can make sense. It can lead to additional tax issues, and really important to point out that at the end of the day, when adding someone on as a joint owner, you're essentially relinquishing some of the control of that asset. Beneficiary designation. So talked about this before. In simple scenarios, yeah, it can definitely make sense to have beneficiary designations, or maybe if there's discussions in advance, but it's really important that these are updated and specified with all parties, because in some scenarios, an estate beneficiary designation can make a lot of sense just to avoid future problems and create simplicity. Finally is insurance, and when referencing insurance, not talking about term insurance, that would be something that's used to replace income or for debt coverage. This would be permanent insurance. So dependent on your scenario, it can sometimes make sense to have a permanent insurance policy in place. What it can do is it can provide a tax-free death benefit. So it can be used to equalize some of the distribution. It can be used to help scenarios like that cottage distribution. If there's an insurance policy that has adequate resources to be used to buy out one party over another, well, then that solves a lot of issues. So not necessarily prescribing this for everyone, but it can be an option that makes a lot of sense. So now I'll pass it over to Joe. He's going to talk a little bit about, okay, that's great. We talked about some of the tax implications, things to be aware of. Where do I go from now? How do I start my estate plan? What are the next steps for me?
Perfect. Thanks, Adam. Yeah, so I mean, the reality is that the steps that we want to take to building this roadmap, so to speak, for your estate are kind of fivefold. And you know, the first one that we want to look at is choosing and informing your representatives. Now, when I'm speaking to representatives today, there's three that I'm referring to, and there is a power of attorney for personal care, power of attorney for property. So these are your representatives while you're still living, and then your executor, and these are the individuals that are going to represent you upon your passing. Determining the composition of your estate. The reality is our main focus is to ensure that you have enough resources to last you throughout the bulk of your retirement or the entirety of your retirement. If we know that there's going to be resources left at the end, what is the composition of those resources? What's the value going to be? What are the tax implications? Well, once we've established that there are going to be residual resources, who do we want to make the beneficiaries and why? Then once we have that, we need to create or update a will, and then creating an organizational structure to make it easy on your representatives moving forward. And I'll kind of speak to some of the resources that we can provide you at the end. So let's look at, choosing these representatives and who is the so-called right person for the job. The first thing is obviously, are they willing to do the job? And the only way that you're going to know this is by having the conversation, discussing with relatives, son, daughter, nieces, nephews, brother, sister, whatever it is, to suggest that, it's prudent for me to start to think about who my representatives are going to be. Would this be something that you would be willing to do? Most importantly, can you trust them? And I don't think that you'd be having this conversation with somebody that you didn't trust. So that conversation is usually pretty easy. But are they reliable? Are they living nearby? And are they easy to contact? This isn't necessarily so important for you. It's an awful lot more important for the individuals that are going to be dealing with them. Especially from an executor side of things, there's been a lot of advancements made in regards to remote signatures and being able to kind of deal with these things when distance is an issue. Having said that, there's still a lot of things that require wet signatures and face-to-face conversations. So the closer the representative is to the beneficiaries, to accountants and lawyers, and the advisors that you work with, the easier it's going to be able to administer some of these things. Do they have a good understanding of financial matters? This doesn't mean they have to be an accountant. By no means is that the case. But the reality is, at some point, they're going to be responsible for running the finances of two households. And do you get the sense that they have their household in order and that they would have the capacity to be able to run two households? And that kind of goes in line with the fact, do you foresee any financial or family challenges that might interfere with their duties? And the only way you're going to know is by having the conversation in advance. Do they have time to dedicate to being your attorney or executor? The reality is, the specific amount of time that is required for these duties isn't exhaustive. However, it can be for a significant period of time. For acting representatives, we can be looking at 3 to 4 to 5 to 6 years if we're looking at incapacity. If you're in a long-term care facility for a significant period of time, it can just be a long period of commitment. In terms of executorship, it's more of a shorter window. However, it's heavier lifting in the earlier going. They don't need to have a whole bunch of time, but they need to at least have the commitment to dedicate some time to your needs. Are they a resident of Canada? This goes back to my first point about the ability to do things remotely. Outside of the fact that it's a lot easier to deal with people that are closer in contact with your beneficiaries, there's tax reasons to make sure that your representatives are Canadian citizens. And if you've run through this entire list and you can't think of anybody, there's nobody that you trust, there's nobody that lives near you, relatives are all in the US, there are corporate trustees that are available to do this job. And we do have a referral available at the end if it's something that you'd be interested in pursuing. So now that we've kind of decided who your representatives are going to be, how do you prepare them? Well, number one, tell them. It's shocking how many people didn't realize that they were an executor on account until it came time to actually implement their responsibilities. And maybe not so much just tell them why they're being chosen. If it's a situation where you're having to decide between siblings, ensure that everybody understands why multiple people haven't been chosen. And as long as everybody's on the same page, it'll eliminate any hard feelings down the road. Ensure that they understand that this role and responsibility is to act in your best interest, full stop. It is their fiduciary responsibility to make decisions that are only beneficial to you, not beneficial to them potentially down the road as maybe a beneficiary. Talking about your financial preferences and wishes, and this is maybe the most important thing. It's okay to diarize your wishes in a will, but make sure that your representatives understand why your wishes are the way that they are, why individuals are receiving certain benefits when others aren't. So that when they might have to have the conversation with beneficiaries down the road, they understand where it is coming from. Discussing an executor fee. Now, if you are to name a son or a daughter or a close relative, typically the executor fee is waived and it's done in a pro bono fashion. However, if it's a non-arm's length relative that is doing this as a favor, a typical standard executor fee is about 5%, but it can be negotiated. You can decide whatever you want it to be and have it written into the will. It's important to note, though, that executor fees are taxable as income. So if it's just going to be two children that are your executors and they're also the full beneficiaries, there's no reason to be adding an executor fee because you would have turned a tax-free inheritance into taxable income. Now, you do have the capacity to assign multiple attorneys. And keep in mind, there are three different that I'm referring to. You know, your power of attorney for property, your power of attorney for personal care, and your executor, they don't have to be the same person. You know, my suggestion would be if your daughter's a nurse and your son's an accountant, okay, well, maybe that makes the decisions for you in terms of which roles they play. However, you are allowed to name multiple people in any of those roles. It does reduce the risk of fraudulent activity. Having said that, there are responsibilities for the institutions to make sure that you're protected as well. They don't have free rein to do whatever they want. However, it can lead to disputes. And the one that is most common is power of attorney for personal care. Children can't decide where, you know, mom or dad should be at end stages of life, and especially if the conversation hasn't been had. So we do see disputes arise in those types of situations, so it can muddy the water. Also make sure that you're discussing and assigning a successor or an alternate. You know, the duties to be a personal representative are revocable. They can decide at some point in the future that, you know what, I'm just not comfortable doing this anymore. I'm just not comfortable committing to this down the road. You want to make sure that you have somebody on hand that can take over that responsibility without the courts having to decide who that is. So make sure that you at least have an alternate in mind, if nothing else. Okay, so why is it important to actually name an enduring power of attorney? Well, it matters if at some point in your future you have incapacity and you do not have the ability to make any financial decisions or health and well-being decisions on your own. It saves the family from having to go to court to decide who becomes your acting authority. You get to decide. And it gives them the authorization to do everything that you could do on a day-to-day basis in terms of, you know, the health decisions, where you end up living, day-to-day banking, paying bills, selling real estate potentially, and dealing with your investments and income as well as taxes at the end of the year. So they can more or less run the day-to-day household that you would have prior to inability to do so. So these are their roles and responsibilities, but they don't have free rein. There are things that they cannot do. And the actions that aren't permitted by powers of attorney are changing beneficiary designations. And I really want to key in on this because this is something we see all the time. Lots of times beneficiary designations are kind of left to atrophy. You named a spouse on your RSP a million years ago, they passed away, you never really thought to change it. If incapacity sets in and now there's an acting representative, they do not have the ability to change that beneficiary designation on your behalf. As soon as there's an acting representative, any beneficiary designation that you've implemented in the past is now binding. They cannot be changed until the time the assets are actually distributed to those beneficiaries. So keep updated beneficiaries on a regular basis. Do not have the ability to change ownership to accounts. Adam kind of referred to the benefits and pitfalls of joint ownership on accounts. This is something we see all the time. You know, can't I just be added to mom's account? That'll make things a lot easier. If it hasn't been done prior to actually implementing the acting representative, it can't be done after the fact. Making gifts or loans. Now, having said that, there's a small caveat to this. They do not have the ability to just, in an ad hoc fashion, send your money to grandkids or kids or themselves because they think that's what's best. However, if you have it in writing and it was predetermined that at Christmas time, I want the grandkids to get $1,000 each. Well, they do have the ability to administer that, but it should be in writing and it should be on hand at the financial institution that's actually going to be dealing with it, so they have something to refer to. What they can't do anything is if you're an acting trustee or if you're a signing officer on a corporation. Powers of attorney cannot step in those instances. A new individual has to take over those roles in each one of those instances. So now that you've kind of figured out who your representatives are going to be and you know what the plan is going to be, what your state's going to look like and who's it going to go to, that is not the end of the process. You know, this life gets in the way, and this is something that we should be reviewing on a regular basis. And standard is every 3 to 5 years in regards to updating your will or at least reviewing your will. But it can also change depending on if the composition of your estate changes. You know, if you buy a cottage one day, okay, well, now the composition of your estate has changed. You know, if you decide to implement insurance, if you make any major financial changes to your life, that's going to require a review of what the long-term implications are going to be from an estate perspective. Don't forget to update your beneficiary designations. I mean, we're kind of beating a dead horse here, but it's just too important. However, even in all of those scenarios, the key drivers for reviewing your plan are major changes in your life. And the four are marriage, common law relationships, children, separation and divorce, or loss of a spouse. Now, with the first two, marriage and common law relationships, it's important to note that entering into a common law relationship does not revoke anything that's in your pre-existing will. Your will just continues on as if nothing happened. So if you want them to be a part of your estate, you need to write them into your will. Marriage, on the other hand, is an entirely different ballgame. Marriage contracts more or less represent a nil and void will moving forward. You need to overhaul absolutely everything if you didn't want your spouse to be a part of your will, or if you wanted to make sure that there were other beneficiaries other than your spouse. Children is an important conversation simply because you want to make sure that either there's trusts in place to have residual assets being sent to minor children, or if they're adult children, when you want them to actually be receiving the funds. So without anything in writing, they will just receive residual assets at the age of 18, regardless of whether they're going to be responsible enough to deal with it or not. So those two are really, really important. Having said that, separation and divorce and loss of a spouse are typically the conversations that we have most in regards to estate planning. So for separation or divorce, and Kirsten, I'll just get you to flip to the next screen. As soon as the ink is dry, so to speak, on divorce papers, the first thing that you want to do is update your will and beneficiary designations. You cannot or should not do this prior to actually having an agreement in place. And in fact, it's the responsibility of the institutions to ensure if you're changing beneficiary designations in the middle of a separation or an ICI divorce, that we step in and ensure that that doesn't actually occur. However, once the ink is dry, as long as there's nothing specifically written into the separation agreement that requires you to keep your ex-spouse as a beneficiary, typically we would see that on an insurance policy, for instance, if you had to make spousal support payments or child support payments. Usually you're going to have an insurance policy in place with your spouse as direct beneficiary, just in case something were to happen to you. They need to make sure that those payments continue beyond your passing. Outside of that, though, make sure you update your beneficiaries, because if they're just left there, they will receive those assets. If young children are now being named beneficiary, and this is specific to, if you have a divorce and there's nobody else in your life that you wanted to name beneficiary, then your young children are more than likely going to be the next in line. Make sure that you have rules written into your will. They will receive the resources at 18, whether you like it or not, unless you specify that, whether it be a trust, ensuring that you name a trustee, somebody that you actually want to have the responsibility of dealing with the funds for your children until they become of age. So really, really important, or else they're just going to receive the funds. Beneficiary designations, usually named estate, and this would be after a spouse that you have resources to leave behind, because at this stage, the tax implication is going to occur regardless. There is no survivor rollover. You don't have a spouse anymore. The one instance that we suggest this doesn't make sense is really, really simple case. I have one or two children and no one else to leave the resources to. It's okay to name direct beneficiaries in that instance, assuming that your children are adult. We're okay with you actually naming direct beneficiaries in those instances. Having said that, make sure that you update contingent beneficiaries. Usually when you set up accounts or insurance policies, it's right when you got married and you just named your spouse. Well, if you want to have children added to that, name as contingent beneficiary in the unlikely scenario where you and your spouse pass on the same day. You want to make sure that you have contingent set up there so that your wishes are still met even after both of your passing. This is something that we're coming across a lot, and it's more specific to the fact that people are living longer. And, when most people are enacting their estate, their children are in their 50s or 60s. They're reaching retirement, where the resources that they're about to receive are actually a lot less meaningful to them than it would be to grandchildren. So we're kind of seeing a skipped generation in regards to where estate planning is going. There's a reason to not do this and skip your kids and just give everything to the grandkids if they're minors. and we'll explain why. Let's use the example that you say, I want each of my grandkids to have $10,000 out of my estate. Fine, seems reasonable. Well, what if there are other grandchildren that are born after you pass away? They're going to be left out. What if one of your kids in the branches of your family has 4 kids, and what if one branch of your family has none? So you've disinherited $40,000 from one branch of your family. Is that going to cause issues between the children? If there is nothing written into your will in terms of when the grandchildren will receive the money, then they will receive the money at age of 18. However, what's maybe more important is if you do name a minor, those resources are locked up until they are 18. So even if the parent said, you know what, it would be a lot more beneficial for us to have these resources for education savings, sports, whatever the case may be, they don't have access to the funds until the kids are 18 years of age. And don't name minors as direct beneficiaries for RSPs and TFSAs or insurance policies for the same reasons that I just suggested. They will have the money at age of 18 because you can't name a trust on a direct beneficiary for those accounts. Now, let's assume that you've kind of established your estate plan. One of the things that you can do to actually make the life of your representatives easier is having an organized plan in place so that they know where to access things. So one of the things that we're going to do after the seminar is send you an email with our digital version of our personal records organizer. It's going to be able to allow you to diarize, you know, which insurance policies you hold, where are your investments held, who does your banking, you know, which advisors do you talk to? Everything that would be really, really important for a representative to know so that they don't have to go scurrying around trying to find these things. This is going to make their life an awful lot easier, and they'll certainly appreciate it if you were to implement our little records organizer. Now, those are kind of leading up to the event, polite way of saying when you're gone. Well, what about on the executor side of things? When the event has occurred, you know, what are their roles and responsibilities? And while the acting representative could have a 4-year time horizon and they have kind of day-to-day business to deal with, when it's an executor, it's a lot of business to deal with in a shorter period of time. So there's kind of 5 key elements. The first one is notifying, you know, friends and family of death and making a funeral arrangements, assuming they haven't already been put in place. Also notifying all of the institutions of death. So Canada Revenue Agency, if they have a pension plan, contacting the pension administrator, contacting insurance companies, contacting investment companies. Anywhere that they could potentially have an income stream coming from, you want to make sure you're reaching out to put a stop payment to any income streams. Once that's been done, you want to start to meet with the individuals that are going to be responsible for distributing the estate. Lawyers, advisors, accountants. These are kind of the 3 key to make sure that you have at least some semblance of an idea who you want to meet with. And every one of these individuals is going to be asking you for a death certificate. The reality is, upon passing, they give you a stack about this big because everybody asked for one, so they're going to come in handy. It's also important to note, in regards to dealing with institutions, set up an estate bank account as fast as you can. Because if you set up an estate bank account, although the third tab here is cancel services and subscriptions, there are some expenses that you can't cancel. If they have a home, heat, hydro, water, those expenses still need to be paid. It's really, really nice if you have an estate bank account set up to be able to pay bills out of. So do it sooner than later. And one of those bills is debts and taxes. Now, there's a reason that paying debts and taxes is before settling and distributing the estate. The debts and taxes component means that, you know, Adam kind of discussed the estate tax liability that's going to be paid, the probate liability that's going to be paid. Those are paid by the estate, but they're only paid by the estate if there's money in the estate. So make sure you don't let the horses out of the barn, send all of the resources out of the estate to the beneficiaries before you've paid debts and taxes. Because if the money is gone, it's your responsibility to chase all those beneficiaries down to get some of the money back, assuming they haven't spent it all, so that you can pay tax. On the tax side of things, it's important to note that there's a potential for 2 or 3 tax filings. And the example I'll use is, let's assume that you were to pass on April 30th. That means that there is a regular income tax filing from January 1st until April 30th for all of the income received while you were still living, plus the income amount that is attributed for all of your RSPs and any deemed dispositions for that time frame, so that 4-month window. Now, upon your passing, the reality is you still have resources that are generating income. You have, let's assume it was maybe a rental property. You have investment that are sitting in the estate that are generating interest and capital gains and dividends. They need their own tax filing as well. So you will have to file taxes from May 1st until the end of the calendar year for any tax that's going to be attributed to the estate itself. Now, if the estate isn't wrapped up at the end of December 31st, well, you get to do this all over again, January 1st until whenever the estate is wrapped up. It can be multiple years. So the earlier you can wrap up an estate, the better from a tax filing perspective. Once all of that's done, now you can actually send the money to the beneficiaries as suggested by the will and potentially receive your executor fee in the process. So similar to kind of the personal records organizer, if you are or potentially could be an acting representative, and this is really specific to executors, we're going to send you a digital copy of our personal representative checklist. So I did a really high level view of what your responsibilities are. This gives about 150 different examples of things that you might need to take care of in the event that you're responsible for an executorship. So we'll send you this as well in the email, and it's fantastic. Anybody that we've come across that's had to be an executor has found this really, really valuable. Now, I don't know if you caught the common theme here. The common theme is having conversations with your executors, your representatives, your beneficiaries. And the reality is those conversations can be difficult. Families have a difficult time talking about money in the best of times. When you're talking about money upon passing, the conversations become really, really difficult. And one of the things that I'm going to turn the deck over to Dwayne to discuss is what we can do as an advisory team to facilitate some of those difficult conversations.
Thanks, Joe. Thanks to both you and Adam. I thought you did a terrific job. There's a lot of good strategies discussed, a lot of details. I'm hopeful that you have a better sense of what's involved in a comprehensive estate plan. As Joe points out, you can do yourself a big favor by being as open and transparent as possible with your family members as you construct your estate plans. Of course, in the course of our work, we work with a lot of executors and representatives in administering estates, and you might find this hard to believe, but when it comes to money matters, there can be some disputes and hurt feelings, and we see that happen, and in a lot of cases it's not necessary and could have been avoided had we had good conversations in advance. So one of the functions that we perform is serving as a facilitator of those family discussions to make sure that everybody understands what the motivations and intentions were. When those are not clear or have not been discussed in advance, then all you're left with is a paper record called a will, and there is no context to it. So you do not have a good understanding of the whys, wheres, and whens, and hows, what the intentions were that went into that will. And that's where feelings get bruised and conflicts arise. So having those conversations in advance can be helpful. So we're happy to provide that service if you're interested. Some of the elements of those discussions can view the overall planning process so that everybody understands what went into that estate plan. It can involve reviewing the overall balance sheet of mom and dad in this case, so that they understand what's involved, what the tax strategies are, because some of the strategies and moves that mom and dad might make are for good tax reasons, but if they're not part of the process or the children aren't aware of that, then some things might not make a lot of sense. So having those conversations in advance is very beneficial. As part of those conversations, we'll oftentimes review the estate analysis that for everybody on this call, if you've been a part of the full comprehensive planning process, you will have seen these estate reports, which project out what your asset picture is going to look like at different points in time down the road. And it's good to know the character of those assets and how they're distributed so that you understand the tax implications. And understanding what the end looks like from a tax perspective and how much of the estate we're effectively losing to taxation can inform and guide some of our decision making earlier on. So that's helpful, and it's also helpful for adult children or children to understand what that may look like down the road. So that's part of the process. Our overall approach to estate planning is not to do it in isolation. Of course, it's part of an overarching strategy that begins with creating awareness for yourselves as clients in terms of what your strengths are, what the potential shortfalls might be, and what mitigating steps we could take. And it also involves, to a great extent, helping you organize, whether it be in your tax filing, which of course is upon us now, so we might all be feeling some of the strain of tax preparation. But where there is uncertainty, there is anxiety. And in this day and age, in a pandemic environment, I think we're all quite familiar with the anxiety that goes with uncertainty. We all can do ourselves a favor by setting in motion the steps to putting an estate plan together, getting organized, helping your representatives, your powers of attorney, your future executors, helping them get organized and reducing the anxiety that goes with estate planning. That, of course, in turn gives you confidence that you're going to achieve your goals, and there will be fair and equitable distribution of your assets, and ultimately lead to peace of mind, which is our end goal. So some of the additional services beyond our immediate team, of course, we have access to resources that you may find valuable. Adam and Joe both referenced trusts on a few occasions. And trusts are things that you can document with the help of a lawyer. There's nothing magical about them. They're simply words on a piece of paper, much like a will. But in many cases, if you have a hard time identifying a responsible party to administer your affairs, you can, in fact, use professional trustees. We use Concentra Trust and have had great success with them in the past for clients who want professional trustee services. So we're happy to provide referrals and point out what they can do to assist you in your estate planning and trust planning while you're alive as well. Christine Van Kouwenberg is kind of the guru, one of the noted experts in wealth planning for wealthy families across Canada. She's actually literally written the book on wealth planning strategies for Canadians. It's kind of the reference document that all advisors in Canada use. And she is part of our advanced financial planning team. She's a lawyer who can help with individual strategies. Not in a position to help paper your wills, unfortunately, but she can certainly help with strategy. And of course, if you need a lawyer or an accountant to add to your advisor team and you don't currently have one, we're happy to provide referrals to you based on your geography. So reach out if you need support there. As mentioned, we're going to pass along some reference material to all the participants in this seminar. Those materials include the organizer, the personal records organizer that Joe referenced, the kind of guide or resource for POAs and executors. We'll also provide a white paper. There may be more than one, but we'll provide white papers as required. I know that Christine Van Kouwenberg has a white paper on beneficiary designations, so we'll pass that along. And of course, we'll pass along the link to today's recording. For those of you who weren't able to get on the call at 3 o'clock, don't despair. We're going to send out a link and you'll be able to see it for yourselves and pass it along to friends or family members that you think might benefit from today's material. I hope that you found it useful. Our team, of course, is always willing to help if you have questions that are unique to your circumstances. So don't hesitate to reach out and ask any questions that you might have about your estate planning needs. If you think that friends or family members might benefit from a conversation with us at no obligation or with no obligation, we're happy to be a sounding board and answer questions. So don't hesitate to refer us out to individuals who you think might benefit. And you'll note that there's one member of our team on this slide here, Emily Walters. We're sad to say that this is her last day before she goes on maternity leave. So we wish Emily well and look forward to having her back next spring. Thanks, Emily, for everything that you do. With that, I will conclude by saying thank you. Thank you for taking some time out of your busy day. I hope you all have a terrific long weekend. Take the time that you need to energize, recharge. And again, if you have questions regarding your estate planning needs, don't hesitate to reach out. Take care, everybody.